So look at the reaction post-Fed meeting. The S&P is down more than 5% since the statement came out on Wednesday afternoon, and treasuries have rallied and yields are actually lower. What is the Fed going to make of that?
Well, it is an interesting picture because really for the first time in this cycle, the market is just not signing off on the path in the dots. The dots have the top of the funds rate range getting to 5.25. And as I look at my screen, that's not priced in. You know, we've gotten some good inflation data, so part of this may simply be the markets are expecting the Fed won't need to do what the dots said. But today we had both Mary Daly and John Williams pushing back. So there is this tension, a tug of war, which may be with us for a while.
Who prevails?
You know, I think ultimately the Fed is going to prevail. The chair has said they're going to keep at it till the job is done. If I myself think that's what we will see. We will see the funds rate getting up as projected in the SEP a couple of days ago. So I think eventually on this one, the market's going to come up to the Fed, at least in terms of the peak funds rate.
It can't be good, though, for the Fed or for the markets that the Fed and the markets are on different pages as it relates to the outlook for where rates are going.
No, it's not good. And as I said, there may be a benign explanation, which is the market has so much confidence in the Fed that it won't need to do as much as they say. Or it could be the market challenging the Fed's reaction function. You know, I take them at their word. Inflation is too high. It's been too high for 2 years. It's not been transitory. And I think policy does need to be in a restrictive range for some time. And that's what we heard from the chair and what we heard today. So I agree it's not good. But I think ultimately the Fed will do what it takes to bring down inflation towards the 2% goal.
I guess then the question is just how much damage is there going to be and whether the lower rates are a reflection of the fact that they're going to have to backtrack because you've already got the yield curve most inverted since the early 80s. And we're starting to get some weaker data, including today's flash PMI. So the odds of oversteering, harder landing, rise. Is that the case?
I believe they do. Look, I think that, you know, the chair did say a couple of weeks ago that they don't want to over-tighten or under-tighten, and I accept that. But there's really a risk to the institutional credibility of the Fed if it does not bring down inflation. You know, I think the Fed's models historically have done a pretty good job, but obviously they and I and others missed, a lot of other folks missed the surge in inflation. Now, some of that's Ukraine, but some of it is that the economy is overheating. And I do think that if there is a risk, it may be a risk of oversteering. But I do think if there is a slowdown next year, I don't think there's any reason for it to be particularly severe or sharp. You know, whether or not it turns out to be a recession or not will be in the data. But I do think the Fed's trying to engineer a slowdown, and that's what we're going to get in activity.
Why not look at the falling rate of inflation, which is good news, especially in some core categories which drove us higher, like lumber and others, and the fact that we're starting to see some of the even rents lower. I know that's a big component of CPI. It's a lagging indicator. Why not look at that and pause to see how much damage was done by the very aggressive tightening that's already been done? They've raised rates every meeting since March, and they've had 4 triple rate hikes in a row.
You're exactly right. You know, Sarah, I do think they're looking at that. But as the chair indicated in his remarks a couple of weeks ago and reinforced in the press conference this week, they're also looking at the categories of inflation that are very sticky, what they call the non-shelter services part of the basket. So I do think they expect good prices to come down, used cars and the rest. And I do think we're seeing some evidence that housing and rent inflation is going to come down. So that's all good. But that leaves about half the basket that is right now not yet returning to levels that they want to see. And I think they'll be looking very closely at that non-housing services component and in particular at wage inflation relative to productivity.
So let's talk about wage inflation. So for those that don't understand why the Fed has to target lower wages and higher unemployment, which is not good for America to deal with the inflation problem. How do you explain that, especially with the fact that real wages, you know, they've been falling?
Yeah, it's an excellent point. And let me be very clear. The Fed wants everybody to get a wage increase if it's commensurate with productivity and price stability. And indeed, Sarah, what we saw before the pandemic is that we were actually cutting rates in 2019, even though wages were going up quite nicely because price inflation was too low. So let me be clear. The Fed is not targeting wage inflation, it's targeting price inflation. But right now, wages are going up, depending on your index, between 5 and 7%.